Hi folks, this is Dr. Jeff Camarda. As you view this, my oh my, what a wild ride we've had this February. The markets of course have taken a recent pummeling pretty much across the globe, with values of both stocks and bonds sharply down as we approach mid-quarter. Neither, of course, surprises me. U.S. stocks are trading still at fairly heady valuations, though they've come down some, and have been long overdue for a serious correction, which we have seen, or at least part of which we've seen in recent weeks. By the way, downdrafts in U.S. stocks are bound in the short term to affect non-U.S. stocks, which has actually happened. Call it a bit of the American flu, but I don't think that will last, as most foreign stocks are still screaming cheap, in our opinion. Regular viewers will know that for many reasons, I still think U.S. stocks have lots of upside, but the ride will become bumpier as volatility is returned with a vengeance and interest rates are inexorably rising. The steady upward march of stocks for nearly a year and a half has been most unusual, a unicorn market really, and one you'd best not get used to, and I guess you're not anymore. Sadly, many newer investors buying into Bitcoin and even Amazon with P's over 350, for instance, have no other market. And let's hope, like young Luke Skywalker, that they learn fear before it's too late. For bonds, the tea leaves are much more foreboding. Longtime viewers will remember that bonds have been in a super bull market for some 35 years as rates drop from the 1970s stagflation days. We've been warning about this for years, and lately it seems a week does not go by without several articles bemoaning the trend of bond price drops and the likely dismal fate of those that hang on to them. And even as I record this in mid-February, Valentine's Day, actually my anniversary, my anniversary, the 10-year yield is pushing 3%. Inflation data came out even uglier than expected this morning, and the trend for interest rates going up and bonds going down, I think, is inevitable and dangerous. So unlike our outlook for stocks, we don't think bonds will be higher down the road. Massive forces are lining up to hammer bond prices. A tighter money Fed, the reversion market impact by dumping bonds, quantitative tightening instead of buying them like they did for so many years to spark the economy, quantitative easing. Also a big increase in new U.S. bonds to cover infrastructure and other projects at the same time as tax revenues are dropping from tax reform, dwindling foreign demand for U.S. bonds and others. It's a classic supply-demand situation, and supply is going way up for bonds and other forces at work, driving bond prices down and interest rates up. The Fed wants higher rates, maybe even higher than the market expects, as employment and probably inflation rise, and higher rates mean dropping bond prices. Add on to that big increases in bond supply, as mentioned, and shrinking demand, and it looks like a perfect storm is building to batter bonds. It will be a slow frog in the pot storm, but a massive storm nonetheless. If you have bonds, get out of the pot and share this with those you care about who may not have heard my alarms ringing. So the short of it is that pretty much the same song I've been singing for a long time now. Bonds are a trap and won't be a buy until rates really go up a lot higher and bonds are cheap again. I think that'll be years, if not decades. U.S. stocks are richly valued. They've come down some, but we do have a strong tailwind in the vibrant worldwide economy and the huge steroid injection of tax reform. Non-U.S. stocks are much, much better buys and should be a big part, over 50, if not over 60% of your equity portfolio allocation. Hope that was informative, not too shocking, and happy Valentine's Day to all of you. Hope you spent a pleasant holiday with those that you love. Until next time, thanks for watching. This is Dr. Jeff Camarda.